Okay, so I wanted to take a look at what was happening today, and I wanted to talk really quick about a topic that I think is a big importance. If you're trying to interpret my strategy and methods and stuff like that, and you're running into problems, I want to go over for just a second what I think those problems are, because they're pretty consistent across the board. Um, what problems most people have with analysis and stuff. And the thing is that if you're tracking this strategy that I'm talking about, and you see something like, oh, there was a seller, there was a buyer, and my opinion is to buy, you might be tempted to say that if, say, a seller and a buyer, if S, and then, oh my goodness, look at this. Let's see, and then, and now it's darker. B, S, B, seller, buyer, then buy. You might think this is an intelligent thing to do. You'll say that if I can track out how you determined to click buy, that you can reverse engineer the way that was concluded. And the problem you're going to run into is that I think concluding that there's a buy looks something like this in terms of logic. You have your point, your action, and that the other side, or in essence, the data set, is something like asymptotic. It's I wouldn't say it's infinite, because that implies that it's just enormous, but I think that attempting to define exactly what my data set is means that you need to become me. And that's the problem. It's that the way you condense information into actionable moments is not through series of events that happen in indicators. That's the wrong method. It's the one that's propagated all the time. You hear it all the time. It's to say, find. So what you have to do is you have to remember that you are one of the most important features in the market. Then the other important feature is the public. This is a bunch of happy people. I'm not going to smile. Okay, so you have to understand that the thing that is a market is both advertising information to groups as well as to you. And so when you're sitting here metabolizing information, you're taking it in and understanding what it means. You're not looking for series of events. You're, at the end of the day, looking for a time when the group is wrong, which is always, the group is always wrong. And the way you go about doing that isn't by looking at the group. And here's where things get hard, is that you are given a market to look at, or that you are not allowed to see the data that matters. Okay, so you can't see what matters. There is no way to know when there's a buy or a sell. You are restricted. So how can anyone make any intelligent statements about a market that they're restricted from seeing the important data? Game theory. It's pretty straightforward, and you don't have to understand game theory. The point is that you have to make decisions based on enormously incomplete data sets. That's what you do. Good traders don't say, I know. They can't. In fact, telling somebody that you know something, that you're like 100% on something, is one of the best ways to filter out liars. You can't know. It doesn't mean you can't do well, but you can't know. The point is you have partial information and you make inferences about that. And that's how you detect the crowd. And it's with all of your indicators, all of them. So considering this, that you need a very large data set to conclude one thing, and this data set's incomplete, how on earth can you possibly come to a conclusion? And that is a very hard topic to grapple with, but let me show you how it works. If this point at the top of this, this is 100%, and this is 0%, and you know we're dealing with partial information, we'll say that this distance is truth. Here's where it comes in that you need to recognize. If you're looking at the data set and this is the highest amount of truth available right here, so what is that, 80%? So you can only see 80% of the truth. That is the truth. The market will react to the highest amount of available truth, not the actual truth. Markets like data points. That's what they like. They want to see things happen, but you don't ever get all the data points. That doesn't happen. So the hard thing to do is to believe that you are capable, and this is where that you will get weeded. You will believe that knowing is what you need. Knowing is where you have a 100% grasp of something. And what you need is understanding, which is where that you do not. It's where you have 80%. When you meet somebody who is having a tough time, you don't know what they're going through, but you can understand it. And markets are all understanding. They are not ever knowing. This is, if you can know, you're cheating. So if you're having a hard time putting all these things together and saying, I don't understand the series of events you're tracking, what you're doing, for me, is you're being lazy. You're being very lazy. When you're saying, what's the A, B, C steps that lead me to D, that's all the money, you know? You're being lazy. You're saying, I want to shut off my brain and comply. I want to comply. I want to be obedient. These are the wrong words. I don't think obedient people are successful traders. I do not think that compliant people are successful traders. I don't think obedient and compliant people are good leaders. But they're really great employees, and they're good students. And it's obvious where you learn these behaviors, and why you seek them out is because compliance in the past has gotten you an A on a test and money. Same with obedience. And it tends to be that you seek out the things that you think bring you value. And in markets, what you need to do is seek out understanding. And you comply with your intelligence. So when we walk through these, if you're having a hard time piecing together how to come to a conclusion, remember, it's not a series of steps. More than anything, it's a therapy session with institutional players where we're trying to figure out how they feel from all the silly things that happen, how they're going to fight with each other and what that means. I mean, it really is a lot like a therapy session, that we're going to come to conclusions about people that we don't know. And then we're going to go further than a therapy session. We're going to take bets against them. You don't get to know all the truth. You get to, so that's how the market works. There is no secret sauce. There is no answer. It's that you need to understand the events happening in front of you enough to interpret reality, to interpret that group, to see the institutions. And you matter. Maybe your one contract doesn't matter, but you matter. You are a human being. We're all exactly the same. You can interpret what everyone's doing based on how and what you would do. So let's take a look at today, and I'll try and do that quickly with this in mind. The very first thing that matters to me is not the first event of the day. It was the state of the market at yesterday's close. And I don't have to review my analysis. I can pretty well see what was going on. And I remember we were looking at a potential burn-off. So we were looking, because why? Because tension was really high. So the market was like, we could see this burn. Why would we look at that? Because it was a motivator. Why? Bears. Bears would love to see a burn-off. So there's motivation there for bears to try and cause a burn-off. If today had done this, price would have probably been able to move down like that. The bears would love that. They could get paid a little bit. They've been getting bludgeoned to death. So Step one, I want to understand the state of the market. Why would they be motivated? Well, because tension was high, but also, I mean, bears have been getting beat to death. So let's look at the first thing that happens. Bears. Hi, bears. You're going to, what are the bears trading here for? They want elasticity. Remember, elasticity is where you burn through high levels of tension and it pays the counterparty and allows the controlling party the ability to pump the market further. So they wanted that because it seemed like a fair deal. So they hopped in. Did they trade? Absolutely. Look at tension. You can see it took them a minute. But then as it moved down, they were able to impact tension. Bears are here. Check. They hit, meaning they moved price, and they impacted tension, meaning they were broad enough to impact the probabilities of the market. Now, in this condition, before you look forward, say to yourself, okay, the bears are hitting. And if you remember the steps to get elasticity, first you need the controlling party to move, which means first you see in this case, the bulls step out of the way. Liquidity happens. Did that happen? Second, then you need to see the counterparty hit. And third, you need tension to move. So in this case, you'd had to see bulls move, bears hit, and then tension releases. Now ask yourself, did the bulls hit yet today? Did the bears see the bulls fail? I mean, even into yesterday's close, look, we had a bullish sample right into the close, and look, it gapped up. Did the bulls fail at some point? Did the bears do this correctly? So in that mindset, where's the market going to go next? If the bears hit, where do you think the market's going to go? It's going to go and figure out what the bulls are doing. That's what I would do. If you see this team is playing and they're just coming in like a freight train for some reason, then I'd say, well, what about you guys, right? You look at the other team, and that's exactly what the market did. It immediately moved down and said, what about you guys? Decay crossed over zero, trapped orders showed up, so we had the volume, ended right there, a bullish position. So here's the bulls. What are the bulls looking at? Are they looking at elasticity? Honestly, it looks to me like we have a bunch of, you ready? Eager bears. Why are they eager? Because they got in too early. They jumped the gun and now they're going to get shot in the back. So if I'm a bull and my whole reason for letting elasticity work, my whole reason for this, remember this right here, is to say, if I let that work, then I can get a better position so that, it's not to get a better position, so that I can continue to move this higher. Well, now we just had a bunch of eager bears. So if my objective ultimately is to get things higher, and we have bears who are doing this wrong, then we have somebody we can take advantage of right here, don't you think? So the bulls are now not looking at elasticity. The bulls are looking at these guys. Oh, you guys are wrong. Let's liquidate those mofos, those monkeys, those eager beavers. Let's take them out. Let's do it. Thank you. Are you seeing that? So the way to interpret that bullish position as effective was not to say, oh, there was a bullish position. It was to interpret the fact the bears were eager on something they kind of emotionally needed after like 2 weeks of getting bludgeoned, beaten, just destroyed. And we had high level of tension, so the market was looking at it. So I think the bears thought, hey, we're going to get in early and win. And the bulls were like, cool, that's what we needed. We needed you to jump in and make bad choices. Do you see that? Hopefully you could see that. The way to determine that was not because it happened. It was because of the context. So as the market moves back up, we get this to cross over a little here, but the volume you can see just doesn't quite line up. Right here, it finally lined up. So here's a bearish sample again. Now, what are these bears looking at? Well, at this point, it's not elasticity anymore, is it? Because the bulls hit, see price moved. Did they impact tension? Yes, you see tension curled up right there out of the low. You see that? Bulls are here. Check. So are these bears looking at elasticity? Heavens no. If these bears were going to get elasticity, those bulls at the low would have moved. These bears are scared because the controlling party, the one with control, is here. Okay, so we're to the third sample. The bears are concerned. These bears are probably the same as these bears. Adding to a loser is the worst idea on planet Earth. Don't ever do it. It's a bad idea. Add to your winners. So these bears are concerned. They're getting a sample. And look, you can even see that they kind of hit. And look, if we mark that out, let me turn this off and then I'll mark it with a level, right where the bears were. Look at that. It had a hard time getting under. And I'm going to just go ahead and bet why. It's because anyone who understood, who was an informed trader, said these people are buying out. The market's having a hard time moving below that initial bearish position because those initial bears are probably pending long orders to dump. And it's keeping it from getting down. They're wanting out. They see what's happening. This elasticity that they were hoping for just disappeared. So what's next? Just for a moment, consider the events. And this isn't because I can see the rest of the day. This is how this works every day. It's like similar narratives. If you have two groups of players and you're a bull right here, what are you going to do? What would you do? Would you let the price come all the way down and stop you out before rallying? Would you let price come down and go through your position? Would you shove it straight up? What would you do? Well, let me tell you the mens rea of the market, the mindset, the thing that matters. These players need to now emotionally trap. We need emotional traps. Bears are in. These guys were wrong. These guys are scared. These guys are eager. Okay, so the emotion, how do you emotionally trap a trader? It's really simple. Let the market sweep 1 or 2 points. Big enough that it catches your eye and it's pretty, but small enough that it actually doesn't give you an advantage. And that's just how it works. Look, you see these pushes? Oh my goodness, it's even through a pivot. So it's like it's pushing a new low, right? A lot of people probably saw that. It sweep down, a little pop there, but it never really gave them anything back. So the emotional trap, and this happens a lot, once you know your counterparty's trapped, you let the market emotionally trap them out. And it's really simple. If you have a position that's open and that position is upside down, if the market just sits there for 2 hours, you will be so emotionally exhausted you don't care. And this is what it did. They emotionally said, well, just let it hang out, just don't let it come down. And this emotionally trapped in these two groups. The whole objective here, even if you didn't track the emotional trap type of thinking, likely your answer to what would you do is we'll take these guys out. That's exactly right. They're probably going to liquidate up here. We have here, up here. And you could see that after that happened, there was a nice steady push up. This interests me though into today's close, and I'll explain why in a minute. But if you have the bears trapped in, you have trapped emotionally and physically, and you push the market up against them, what do you anticipate they would do? Dump. That is your The bulls right here anticipated that they could get the bears to dump. What does that look like? A dump has 2 features. 1, price sweep. More like a snap. It's just like, boom, you see it hit all that going on. 2, tension. Oops. Curls. So these are the 2 things. And you know that because if you want to pump tension, you got to liquidate the counterparty, right? You push against them, and then once they let their position go, tension will curl. Well, what's this? And we've seen this before, and it's important that you understand what's going on here. There's 2 things you need to keep in mind. tension didn't curl. Okay? That this is moving up, taking really aggressive stabs at the bears' stops, and tension's not curling. That means bears didn't, there we go, let go. Bears are holding. Why? And this is where we are. We have just come to the narrative conclusion of today. And it's not conclusion as conclusive. That's all we're getting right now. The episode just ended. Why aren't the bears letting go? Why did the bears hold on to their position and now they're underwater some almost 30 points or 20 points? Why? So if you can answer that question, you might be able to get a leg up on this. But I can tell you right now that these bulls who are in control of the probabilities of the market, you see, both are up, and they caught these guys upside down. These are in losing positions, negative money. They're not going to let go without a fight. So the question you have to ask is, why would the bears expose themselves to this much? Why would they do that? And there's two things that could happen here. There are only two things that could happen here. The first is the bulls push more. And as long as nothing happens in the world and everything just keeps going status quo, that's what's going to happen. This will continue forever until tension curls up. They will not stop because they're nice or something. If the bears want to hang on and they want to lose money for the next 40 points, great. I'm happy because that's more money transferred and bigger profits. I don't care what they are doing. The point is, the bulls are not going to stop because those bulls are just so courageous. If you're in a losing position, you are so disadvantaged. It's not even funny. So the second option is that the bears are insider trading. Congress is going to pass something that they already know is going to pass before it gets passed. It's super illegal on a lot of levels. A lot of levels. The bears know something that is telling them that it's okay to hold on to enormous amounts of risk. There's something that they see that says don't let go because, and the public doesn't know it yet. Insider trading is a huge favorite of the bears. The bulls don't do it that much. It does happen, but the bears seem to be a bigger fan. Why are you holding on? You should ask. And that's where we're at. I don't know why they're holding on. I don't know if it's just stupidity. I don't know if it's because we got some percentage back up the pandemic rally. I have no idea. But I do know that I can see these positions are stuck underwater and they should have let go. And so I understand that these guys are probably sweating bullets. And if they're not sweating bullets, they're cheating like crazy. Something. So I don't know which is going to happen. I don't know. I don't know if the bears know something and so something's going to happen overnight or maybe tomorrow that's going to give them an advantage. I don't know. But it has my eyebrows raised, and I'm curious why they're so holding on. They shouldn't be. So either some news event happens, and if it does, be aware that this is the root position. Not up here, it was here. This is where the trade started, not up here. So if we had a news event and it was like, let's just say, I don't know. You'll want to go, well, here's where it started. You're wrong. It started here. This is where you need to draw the start of that trade. This whole nonsense was the time when the public was, well, uninformed. While they had an unfair advantage in the market. So that's important to know. If no big event is coming, this is not going to stop. If they don't have an ace in the hole, if they don't have something good, a little news event's not going to do them. They're going to need something that's going to open the market tomorrow at negative 1,800 or negative 2,000. That's what they're going to need, the advanced decline, that's this number, to be open and down like that. That's what they're going to need, and it's going to have to be some sort of aggressive event. And if that event's not a real fundamental, meaning it doesn't scare traders, not that it has anything to do with the economy, a real event scares traders, which typically has to do with laws being passed. If there's not something real like that, those bears, you think they're going to hold on to something? Cheaters don't hold. Cheaters want quick profits. This will come down and they'll want out, and it'll come right back up to that area. That's what'll happen. It's what happens. Cheating doesn't sustain trends. So that's where we're at. So we figured out the data points that we can look at. We compared those to the previous day's condition, and that was looking at tension. We looked at how those traders in those events were impacting tension and everything. We could see that all three of them had participants, bears, bulls, and that the bears were screwed. They were too eager. They didn't do it right, and the bulls knew it, and so they were looking to liquidate them at this point. I mean, right here, you knew if you were keeping up that they wanted to liquidate, and that was going to be like up here, like a couple points above their position, easy. It's not usually 1 or 2. It's like 3 or 4 points above that. So up here, and you can see we got a good stab. And I think right here, it was like, why aren't you guys letting go? Because tension, you see. Oh, because you're dumb. And then the market just kept going. Stab, stab, stab. Why was it doing that? They were holding. They wanted to get margin called, obviously. So unless some news event happens, bears are in a lot of trouble right here. A lot. And I'm actually pretty surprised because we have seen nothing but failure by the bears in like a really obvious way. So seeing them come in and say, let's get overconfident now. I don't know. We haven't seen any instance where the bulls fail. We haven't seen that in like 2 weeks. We've seen instances where the bears were able to maybe scalp a little bit, but that doesn't change the trend. Pushing price down isn't enough. A price-only move that's just it. It's price only. It doesn't impact probabilities, the whole structure. It's just a little movement. And typically, a favorable move by the counterparty is an advantageous opportunity for the controlling party. So like today, they pushed it down, and it was the bulls found opportunity in that. So it has to do with context. It wasn't a series of events. So if you're struggling at any point in your strategy or this method, it probably has to do with the fact that you're interpreting too low of a level, too superficial. I guess maybe that's too high. High level sounds more intelligent. So too low of a level is too superficial. You need to look at the impact that those data points have on the relevant decision makers in the market, not the other people. I mean, the other people are meh, but the ones who control trends. So at this point, as far as I can tell, this was more bullish success. So bulls again win. We've seen this over and over and over. We had a little bit of bearish, sort of, but they did this wrong. So it was a big trap. So the bears were able to get a trade in, but they weren't able to actually be successful. They weren't able to actually change the trend. So in the fact that the bears sort of failed to do anything, it was a win in that regard. And the same thing that happened back on Thursday is kind of what happened today. You had eager bears coming in, pushing as hard as they can inappropriately, and getting destroyed. So that's where we're at. Next, the thing that's coming up is to distinguish, are these bears insider trading? Do they have something up their sleeves? Which from the look of it, it's going to need to be aggressive, whatever it is. Otherwise, they're just making bad choices, which I'm not surprised at all. That's where we are. For me, I can't actually, this is important, I can't define, I'm not allowed to, I cannot, so we'll say not define news. And the reason is because to access the news, you need to know people, and you need to, and I don't have access to those avenues. They're like clout things, like it's who you are, or maybe what institution. It's a whole negotiation in a anarchical world of game theory and who matters and who doesn't. I don't have access to that. I can't define the news. But I can tell you right now, the Bears think they have something. I can see that. The Bears think they think that's why they're holding on to so much risk. And maybe I'm interpreting that wrong. Maybe. But I think that's what the Bears are. I think they're like, no, hold on, don't let go. It's gonna work or whatever. Essentially, what's happening here is their risk tolerance has shot through the roof. Why are you tolerating so much risk? Why? Why is your risk rising? And typically, your risk rises when that's not right. Push this little button here on. Okay, your risk rises when your guarantee. I don't know why I drew an S. Of reward rises, or at least you're perceived. When you think that a reward is guaranteed, your tolerance for risk shoots through the roof. When somebody says, I guarantee with my life that I will bring you $10, your tolerance for how risky things get in between now and when they give you that $10 goes way up because you believe that guarantee, and you'll tolerate a lot. And so the question is, how's this going to work? And here's some fun math. Okay, are you ready? This is pretty typical. This is a solvency thing. And in my experience, what solvency ends up really being at the end of the day, and there's a lot of math formulas, okay, but at the end of the day, in terms of experience, what it feels like is when you're insolvent, it means you are simultaneously right and at your breaking point. So essentially, if the guarantee of reward is high enough, you will allow the risk to move past your breaking point. And that's when you get into those situations, which traders always do, is they become somewhat insolvent. You are simultaneously right and wrong. You're like, I know it's coming down. It shoots up, stops you and everyone else out, and then moves down. And then you get to enjoy saying, I was right, I just couldn't hold on to it. And the point is that you weren't early. Okay, so this is not early. Okay, I want to make this distinction because a lot of people will try and minimize the decision by saying, I was just early. This is insolvent. And it is a form of wrong. You were neglecting your risk because you were too focused on your reward. That is insolvency. That is the problem. And so this could move up and it could make these bears insolvent. And it doesn't matter what they saw. At the end of the day, they're going to pay out and be right. So who cares if they were right? Who cares what they see? I don't. So that's the situation. It's an insolvency problem. And we deal with this all the time. The trick to get around a solvency is to make sure that you're participating with the right group. If you're not playing ball with the right people, then you get into these solvency problems where it's like the bears were right, sure. And most likely the bears are saying something like this: riots, high job loss, pandemic. And in the end, they get to be right and insolvent because they're misinterpreting. Markets do not, let me just say this, markets do not represent poor people. And that's people who don't have jobs. That's people who are rioting. It's the people who, they don't represent poor people. They don't represent small business. Markets represent one thing only: It is the rich and powerful's perspective on the biggest and most profitable corporations. It has nothing to do with the poor, nothing to do with the sick, the needy, the helpless. Those things don't make a difference. So you have to understand the people with power and control, and you have to understand how they feel and how they play, and what their perspective, not their perspective on the most rich and powerful corporations, not small businesses. Okay, so that's where we're at. We're going to find out what the bears know or don't know. Either way, their solvency is getting pressured heavy. So good luck. See you guys tomorrow.